Good afternoon, everyone. This is Teresa from Early Growth. We'll get started with our presentation in just a few seconds. We're going to give some people some time to get on. All right, awesome. Looks like we have a lot of people joining. I'm super excited about that. So let's go ahead and get started. Again, good afternoon and welcome to today's webinar, Making Sense of Cap Tables. And this is presented by Early Growth. My name is Teresa and I will be your moderator for today. And I am from the Early Growth marketing team. So I just want to give a few quick notes. This webinar will last approximately 60 minutes. That does include time for Q&A at the end. You can place your questions in the question panel, it's a Q&A panel. If you happen to drop it in the chat box, don't worry, I'll still read it there. This webinar will be recorded and sent to everyone who registered for today. We'll send that out in 48 hours via email. You can also find this recording and all previous webinar recordings on our YouTube channel. And with that said, let's get started. Let me just tell you a little bit about Early Growth. You may, if you see these logos at the top, you may recognize some of these companies. These are some of the companies that we have worked with. Early Growth was started over 10 years ago by David Ehrenberg, who is our founder and CEO. And I'm just going to read this quote quickly. Startups face a huge burden in today's economy, often having to choose between funneling resources towards creating their goods and services or managing the often complex accounting, tax, and financial strategy planning necessary to run a successful business. That was the sole reason why David started this company, to be able to offer a service to those early stage companies where they don't have to compromise being able to move their company further along and still be able to get expert financial and accounting assistance. And the 5 stages that we actually work with is accounting, CFO consulting, taxes. So if anyone needs any tax help right now, let us know. Valuations and fund accounting. Today we have Vincent McCord. We're going to call him Vince. He's one of our consulting CFOs at Early Growth. And Vince, I'm going to hand it over to you if you want to tell us just a little bit about yourself before we get started.
Okay, thank you, Teresa. Good afternoon, everyone. I am a consultant CFO with Early Growth. I've been with the firm for 4 years now. I am located in Los Angeles. We have teams in 7 locations in the country, around the country. Our biggest group is up in the Bay Area in San Francisco and Silicon Valley. Then we have people in Seattle, Chicago, Boston, New York, and then, of course, our group down here in Los Angeles. I've been in the finance field for, well, I'd rather not say how long. It's over 30 years. Prior to joining Early Growth, I was a CFO for 13 private venture-backed technology companies and 1 public company. And then prior to that, I had a number of years in finance with 3 large Fortune 500 companies. So, you know, a long experience in finance and dealing with a lot of cap tables over the years. So with that background, why don't we get started?
All right, awesome. And I just want to say for everyone who registered today, we do have a special tax promotion. I'll be going over that at the end of this presentation, so please stay until the end. All right, let's get started.
You know, when you think about a cap table, you know, what a cap table really is a document in somewhat of a summary form showing the ownership and the overall equity capitalization structure of a company. Now, this includes the company's founders, its executives, employees, and of course, investors. And it's important for a number of reasons. I mean, first of all, it shows ownership, who owns what. And within that, it can show the control depending on the class of stock and the ownership of that class. And also it can be used for various functions, various important functions, including forecasting the effects of planned financings that the company could be considering. It's also very useful in an audit in that it shows the financial audit team and the legal team sort of a history or a snapshot of the company's financing. You can think of it in a way, it's somewhat akin to a balance sheet. It's showing the equity ownership position of the company at any given point in time. And you see here several terms and subjects that can come into play, and this is just, a representative list. The other thing I would add is that any one of these can take a myriad of forms or importance or particular issues that could come up. Obviously it's showing who owns what. It says here simple and complicated. That really depends on the individual company. We're looking at this primarily from a private company standpoint, and that could be simple if the companies had very few financings, or it could be complicated depending on the number of financings, the type of investors, the various classes of stock, et cetera, et cetera, et cetera. It certainly speaks to the ownership rights of the various shareholders. And these include things like voting rights. As you probably know, depending on the class of share or the type of share that's offered, be it preferred or common, the shareholders have certain voting rights. They can have, for instance, voting around issues like board seats or information rights or liquidation events like a sale of a company. That can be determined by a particular class of shareholder, or it could be all shareholders as a group. Liquidation. This is a very common term I'm sure most of you are familiar with, and that has to do with liquidation preferences. And what that really deals with, upon a liquidation event of the company, how do the proceeds get divided up and apportioned to the various shareholders? And then the other one mentioned here, the right of first refusal. That could be a term that is in a particular share class if those shareholders can negotiate that into their agreements. The other thing I would point out here is that always remember that underlying any offering, any share class, are the key legal documents: the purchase document, the investor rights agreement, and the certificate of incorporation. It's those three that had the primary terms and conditions of the stock offering itself. And those are the documents that underlie what you see in any given cap table. Next item mentioned here are taxes. Once again, this can come at you from a variety of areas or subjects. Could be stock compensation and how that affects the income statement of the company. Could be the 1099s that have to go out to shareholders when they make a disposition and get a payout on shares. Or it could be particular shareholders that are in classes like 5% ownership or greater, which are treated differently from a tax standpoint. So once again, taxes are a very important, very relevant subject in dealing with your cap table. The next one here, of course, is the one that's always on everyone's mind, and that is, what is the exit value? What am I going to get for my shares? What is a particular shareholder or class of shareholders going to get for their valuation upon an exit or a liquidation event for a company, sale of the company, acquisition, et cetera? And then, of course, compliance is another one that has a myriad of different subject areas. We talk about financial audits and the compliance that goes on there, legal audits, due diligence that occurs upon a planned offering or acquisition or a liquidation event. And then once again, I think from a practical standpoint, compliance means that your record keeping and accounting that goes into your cap table needs to incorporate and mirror, as I said earlier, the terms and conditions of the underlying documents of the offering itself. Teresa, you want to go to the next slide? Some key terms that we'll be discussing here, and probably most of you are familiar with these. Of course, the shares themselves. A share is just a fractional or a proportional ownership of the company. There are typically two types I consider. One are common shares, the other are preferred. They show here a seed preferred versus a series preferred. I tend to think of preferred shares as a group versus common shares. Now there's another type of instrument that comes into play here, and you see it listed, and those are options or warrants. These are rights to buy or acquire shares at certain price points. Stock options are probably the form you're most familiar with. And then of course, various stakeholders in the company could be investors, could be lenders, could be even customers or suppliers may have warrants giving them the right to buy certain classes of shares at a particular warrant price. So you've got, in addition to the stock instruments or documents, or I should say offerings themselves, you've got these rights to acquire shares, these options and warrants. Now, the next term here, diluted shares. What this really has to do with is the total shares that are out there and what that means in terms of your percentage ownership for a particular class divided by the total issued shares in the stock capitalization. We talk about, I mentioned diluted ownership, meaning the fractional ownership based on the total number of diluted shares. And then you hear this term, shares outstanding. That speaks to the shares that have actually been issued and would not include unexercised options or warrants that have not been exercised. These are actual stocks that have been issued to the shareholders. The diluted total would include the options and the warrants in the total share count. Want to go to the next slide? Here's some other terms that you're probably familiar with that you'll obviously hear as you discuss anything around stock offerings or share offerings for your company. One is this pre-money. This is the valuation of the company just prior to its next offering. This is the value that's going to set the share price for that planned offering for your next funding. And then post-money would be the value of the company, including the amount they're raising in that contemplated offering. So you got pre-money, total value of the company prior to the offering, post-money, the value with that offering amount that's taken into account. Some other instruments you'll hear about in discussions with capitalization, this term SAFE, many of you may be familiar with. SAFE stands for a simplified agreement for equity. It's basically the structure of a convertible note. And because the note holders in these situations are contemplating ownership through shares in the company, they're willing to classify their notes as equity. So it's really a debt instrument that the company is able to classify as equity on its balance sheet. So it helps in terms of capitalization in that it's capturing that as equity on the balance sheet instead of debt. That's simply what that means. And then you may see safes listed on a cap table. Remember, it can't show a per share amount because it's just a total dollar amount and you don't know what the conversion price of the shares is going to be yet. So it may be just a total dollar amount on the cap table itself. Then you've got notes, which are debt instruments, and other debt. Those, while they do come into account in the total capitalization of a company, because the capitalization would include debt as well as equity, they normally are not shown on the cap table. Safes maybe, but not notes or debt on the cap table. So, Teresa? Let's get into a typical cap table example, and here's one on the screen. This is a kind of a summary form level in that it's showing common, preferred, and then the option plan down at the bottom. And you'll see a couple of things here. First of all, here the outstanding share counts for each of these different classes of stock is in that left-hand column. Then what's interesting is this column here called conversion ratio right next to it. Oftentimes what you'll find in preferred shares is depending on what the preferred class shareholders have been able to negotiate, you may have a conversion ratio that's higher than 1. In other words, at the end of the day, everyone's going to want to see the total share count on a common basis, which is referred to as converted, or it's really, in a sense, kind of a common share view. So it's as if everything was converted into one class of share or common shares for a total share count. What can happen is in certain classes of preferred stock, as I mentioned, those stakeholders, those particular shareholders have negotiated a higher conversion ratio. So their shares, when they convert to common stock upon a liquidation event, let's say a sale of the company, their share count will actually go up in the total. So when they convert, they're getting an enrichment, in a sense, in their total ownership through that conversion factor. And once again, that is usually a negotiated term in the offering as it's being made for that particular class of share. You'll see here there's no uplift conversion ratios factored in here, so it's really not an issue at this point. The other thing I'd point out here is if you look down at the 2016 plan, which represents your option pool, you'll notice that all of those, I think if you scroll down a little bit, I don't know if you can see it here, but Teresa, can you scroll down a little bit on that one? Maybe not.
No, I can't. I'm sorry.
Okay, the only thing I wanted to point out is that the total authorized is still represented by the options that have been issued, some canceled, and then the options outstanding, and then those that are available. Because in this particular case, none of these options have been exercised or converted to common shares. So the total authorized here of the 1,838,000 is still taken into account in your total fully diluted share count. So why don't we go to the next slide? And you'll see this is just a detailed version of that summary slide. So what this would show is the detailed cap table showing each individual shareholder and what they hold. And you'll notice here there's two ownership categorizations, one based on issued shares, that column says percentage ownership excluding options and warrants, and then there's the final fully diluted ownership percentage in the far right column that in this case takes into account the option plan. It's assuming it's almost as if all those options are assumed to exercise at one point. So it's conservative from that standpoint. Want to go to the next slide? And here's just to follow on. I guess there are a couple of pages to this. And here are some more relevant subjects in dealing with your cap table. As I mentioned earlier, it's like a ledger. You could almost think of it like a balance sheet, which shows the dates of investment. So there's a history, in a sense, built into it. The other thing here that I mentioned earlier are the supporting documents that need to be accounted for and always addressed both to the shareholders and to the corporation itself. And that has to do with stock certificates, which your law firm, if you're working with an outside law firm, they will issue the stock certificates. They can also hold the stock certificates for the shareholders if the shareholder prefers that. Oftentimes it's simpler for them. The law firms are very adept and used to keeping the certificates on hand, so that's not an issue. It's easy for them to administer. All ownership documents, like I mentioned earlier, purchase agreements, certificates of incorporation, investor rights agreements, make sure you always have complete sets of those. The law firm will have it. Certain shareholders may want copies of all those. They usually get those with an offering, but you may get requests for additional copies, that sort of thing. Make sure, as it says here, that they are complete, that every investor, stakeholder has copies of complete documents. Now, there's some other points mentioned here down at the bottom. Insurance. Remember that, in a sense, the cap table is keeping a record of the value of the company at any given point in time. you want to do all that you can to maintain that value. And so the insurance that you should think about as regards the equity ownership are things like general liability insurance, directors and officers insurance, which insure against, claims made against officers of the company. You can even get entity coverage for the corporation itself. Once again, to protect against shareholder suits. Errors and omissions insurance is another one you should be considering, because it covers things like accidents made by professionals. In this case, it could be lawyers, could be accountants, that sort of thing. So once again, that kind of protection to ensure the value of the company is very important. Another example now is cyber insurance that can protect you for breaches against this kind of information. So there's not a security breach involving equity or financial information. So I would recommend looking into all three forms of insurance here: general liability, directors and officers insurance, errors and omissions insurance, to ensure, once again, that you're maintaining the value of the corporation as best you can. Know what the rights mean. This gets back once again to the agreements underlying these offerings. Make sure you understand what each shareholder class has in the way of voting rights, liquidation rights, anti-dilution rights or privileges. That's another one we'll talk about in a minute, and that is that when you get into a situation where a company is having to go through what they call a down round, where the valuation for the next offering is lower than previous offerings, typically preferred shareholders have anti-dilution rights, which give them a certain degree of protection against dilution due to lower valuations occurring in the future. So that's another right you need to be familiar with, that's covered typically it's in the certificate of incorporation, but once again, it's in the underlying documents of the offering. So make sure you have a good overall understanding of the various rights that each shareholder class has through their ownership. And then the compliance items I talked about earlier, a variety having to do with ownership, record keeping, terms, insurance, et cetera, et cetera. But it really gets back, I think the main thing is the record keeping itself. Make sure that your record keeping supports what the agreements state that the shareholders have acquired. Next slide. Now, how do you do all this? In a sense, the cap table itself is like the top level document for all the supporting documentation in detail. In the past, companies relied on Excel spreadsheets to maintain a lot of this. And it was very complex, very difficult. Typically, my experience was the private company looked to its law firm to maintain this, because one of the things you can easily get involved in are disputes around share counts and ownership percentages, et cetera, especially when you get into trying to project what the effect of future offerings have on dilution, ownership percentages, et cetera. So what happened was companies came along to create software designed to make the cap table management easier. You see two here listed, CapShare and Carta. These are well-known, popular software products out there for managing your cap table. I highly recommend using one of these or others that are out there for a couple of reasons. One is it takes the dispute out of these projections in terms of the effect of future offerings. That's probably the main benefit. The second one is it's a centralized location. So what you can do is you have essentially one cap table with multiple users. So that cap table is used and accessed by the law firm, your various investors, including venture firms or private equity firms or whomever, your professional investors. Everyone is working off the same cap table, the same set of data, and it just eliminates a lot of consternation and debate, et cetera, et cetera, et cetera. Also, too, and you'll see this in the last few points here, this cap table software can support really an online data room. So what you've got, in addition to the cap table itself, you've got your underlying documents, the certificates, copies of the agreements, et cetera, and the ability to do these simulations to project what's the impact of future offerings. Also, they can be used to calculate stock compensation that goes to option holders that the audit firm will work with. So it fills a variety of needs, it simplifies things, and it gets everyone consistently working off the same set of data. So I think there are many advantages, and I highly recommend using cap table software.
And there you have it. Thanks so much, Vince, for breaking down cap tables, which is such a complex topic. For anyone who would like more information or just learn more about us, feel free to follow us on any of our social platforms or visit us at earlygrowth.com. Before we head to Q&A though, I promised to tell you about our tax promotion. So right now you can get $500 off of your C Corp taxes. So anyone who has a C Corp, we are offering that to you just by going to earlygrowth.com/tax promo. The deadline is April the 1st to take advantage of it so that we are able to get that done by April 15th. I'll put this up before we end, but let's head on over to our questions. Let's see here. All right, so we got a few questions going on, and Vince, I will go ahead and start. And let me read this first question. Actually, this is from Amjad. What about shares authorized versus shares outstanding?
Yeah. The authorized shares really come into play on the option side for the most part. In other words, when you're doing fully diluted calculations, you're really working with issued shares in terms of the commons, the preferreds, et cetera, et cetera. So in my opinion, it's the authorized shares in the option amounts that haven't been exercised, where you've had no exercises, where it's just the total authorization actually comes into play.
Okay, then I have another question. Our company bought back some common stock from founders that left early before they vested. It was our understanding that these shares would then belong to the company and fall under treasury stock. It was also our understanding that these stocks would not be outstanding, but would contribute to full dilution. Is that correct?
It's treasury stock. I don't think they would contribute to full dilution. I think it'd be removed.
Okay. All right, then we'll go on to the next question. What is the main point of truth for ownership? Is it the cap table, stock certificates, or underlying purchase agreements?
Well, strictly speaking, it's the certificates, but there would probably be other supporting documents, including correspondence with the company or its law firm and the documents themselves. But at the end of the day, the best thing you can have are the certificates.
Awesome. Can you discuss the pros and cons of safes versus notes?
Yeah, I think from the company standpoint, the safes are better in that they're classified as equity. And to me, as a finance guy, you know, the more capital you got down in equity versus debt, the more conservative and sound it looks. From the note holder's side, it's really not a disadvantage to have it as a safe. I mean, the provisions are the same, the rights are the same, et cetera, as far as future offerings or interest rates that accumulate. So I just, if you can negotiate from the company side a safe, I think that's a plus.
What is the difference between series versus seed preferred?
Oh, well, seed, that really speaks to stage of the company. Seed, I would say typically, but not always, does not include, professional investors like venture capital firms, et cetera, et cetera. Also, well, obviously, you're getting in typically a lower price in terms of valuation. So that's a benefit. But in terms of the legal documents and structure, they're pretty much the same, at least conceptually. Now, I will say that the preferred shares, since you're dealing with a bigger group of investors in terms of size and experience and professionalism, they will probably negotiate terms into those agreements that a seed investor may not. So there's a difference from that standpoint. But generally speaking, it just speaks to the maturity and stage of the company.
Okay, we have a question from David. Can you explain a little bit about how safes eventually convert to shares?
To be honest, I'm not an expert on this, but I don't think there'd be any difference between a safe and a convertible note in its conversion to shares. I mean, typically these have a time limit, 24 months, et cetera, in which there can be an automatic conversion. Or if the company is just not matured, then they essentially go away in a sense, or they're paid off if possible. But I don't think there's really a big difference in conversion between a safe and a convertible note itself, since they both have the same intent.
Awesome. Thanks, David, for that question. Our next question, how would a cap table differ, if at all, if the company is an LLC versus a C Corp?
Yeah, well, the big difference is going to be an LLC usually has one class of holders. They're all considered partners. And that's the reason why it's difficult to get professional investors, venture capital firms, PE firms, et cetera, to participate in an LLC because they want to have class distinction. They want their preferred shares to have rights that the common shareholders don't have. So that's probably the biggest difference right there as to who makes up the share group, because as I said, with an LLC, it's one class versus a corporation, which can have various classes of stock.
Awesome. And Steve, I think we just answered your question about those shares. We have another question from Vanita. How can CART software help me with using cap tables, or are there any other or better alternatives to CART?
When you say CART, is it CARTA? Is that
CARTA, sorry, yeah, software.
Yeah, I think CARTA is good. I think the functionality of CARTA and CapShare and others is pretty much the same. And as I mentioned, in the formal presentation part, it's just extremely powerful. I mean, and when I say extremely powerful, I'm talking about projecting future offerings as regards anti-dilution rights and the effect there, or the preferences. If you look at various buyouts of a company below the last round's share price, this shows who gets what. It very easily and less controversially shows what the proceeds would be to each share class in various scenarios. So that's probably the biggest plus. The other is, once again, the fact that it's a centralized cap table. Everyone's looking at the same data. You don't have different groups keeping their own version of the cap table. So it takes a lot of controversy out of it from that standpoint. And then, as I mentioned earlier, it's a centralized data room. So you've got all your backup documentation in one location. So it's great from an administrative standpoint.
Awesome. And have a question from Holly, and then we'll take one more after that. I have an LLC and I'm the only member. What do I owe my investors in terms of tax disclosure?
If they're the only member,
An
I don't
LLC.
quite understand the question. Are they saying there are other shareholders besides?
Holly, why don't you give us, clarify your question for us, and I'll come back to you. Okay, so let's go to another question from Evan. If we are complete beginners at raising capital, what advice do you have? Should I get a lawyer or hire a consultant like Early Growth to ensure we are raising capital the right way?
Both. No, to be honest, you got to consult your lawyer first. I mean, typically, my experience with startups is the law firm is involved with the company before the finance professionals are. So I would start with the law firm and then go to a service like Early Growth. If there had to be a sequence, that would be the sequence.
All right, thanks for that question, Evan. And then I have, let's see, do I have one in the, okay, so that was just a comment in the chat box. Okay, so Holly just gave us an updated question. I formed as an LLC and I'm the only member. And later I took on a few investors, friends, and family. Does that make it any clearer? If not,
Yeah.
we can actually email you, Holly.
Yeah, I think it does. I mean, what you got to do is those investors would have gotten shares or partnership units in the LLC. So depending on the particular situation, the tax information would essentially be the same in terms of the subject matter. What's going to vary is going to be their impact, their specific impact, depending on the number of share units that they have.
Awesome. All right. And that will conclude our Q&A. And once again, I just want to remind everyone about our promo. If you do need to get those taxes done and you have a C Corp, please go to earlygrowth.com/tax promo. The deadline is April the 1st. If you have any questions about that, you can reply to the follow-up email, or you can email us at webinars@earlygrowth.com and we'll get your questions answered. Thank you so much, Vince, and thank you for everyone participating today. We will send this recording to you in the next 48 hours. Thank you.